Hey guys, and welcome to today's session. And this session is all about understanding your Darwin. Now, we understand that the Darwin comes with some complexities and maybe some intricacies that you've never experienced in this industry before, trading with personal accounts through a broker or with proprietary funding accounts. And so we like to dedicate this one session per week where we go into those intricate details, where we look at the risk, we look at the VAR, and all of these metrics and abbreviations that you might have heard of, but might not exactly know what they mean. So we're going to do a deep dive into all of those today. So if you do have any questions while we're going, whether you're watching on Instagram, YouTube, X, or Discord, please just pop them in the chat and I'll go through them as and when you guys send them in. Now, my name's Kieran and I'm head of UK growth and business development for Darwinex Zero and Darwinex in the UK. And Darwinex, if you haven't heard of us before, we are a regulated asset manager and broker. We are regulated in the UK by the FCA, in Spain by the CNMB, and also in the Seychelles by the FSA. We currently have just over 100 million US dollars invested in the platform by third-party investors outside of Darwinex Capital. And we have over, I need to update this presentation, it's actually over 11,000 strategies or active strategies now. Don't always call these traders because we have some traders that have multiple trading strategies and run multiple Darwins on our platforms. So we'll jump straight into the meat and bones on what is the point of a Darwin and actually what is a Darwin. So your Darwin, once you've signed up with Darwinex Zero, you have a MetaTrader account that we send to you, right? That goes through the Darwinex broker. Now, what we do is we take your trades from your MetaTrader account and we put them into a synthetic index called the Darwin. Now, this is held at Darwinex level, so it goes under our asset management license, meaning that you can legally take investor capital because you don't take ownership, you don't access the funds, right? It's all held at Darwinex level. Now, your Darwin is risk adjusted to a value at risk of 6.5%, which we'll get into in a moment. And I'll hopefully answer any questions that you guys have before you even ask them. So as we're going through, as I say, if there is something that you think of or a question that you want answering, please just pop it in the chat. But the point of a Darwin is, one, so that you have a risk adjusted version of your strategy. Now, not everybody appreciates this to begin with, but over time, and if you want to become more professional, you'll kind of embrace the fact that you have a risk adjusted version of your strategy. You'll understand risk more, you'll understand your exposure, your strategy at a deeper level, and you'll understand actually how you compare to industry benchmarks like the S&P. Because we level out your risk as a trader to the standard of the S&P, you can basically see, do I outperform or do I underperform the S&P 500? Unless you're outperforming it, there's no point in an investor backing you with capital, because your first goal as a trader should be to beat inflation, and then second should be to beat the S&P. Again, if you can't do any of those two goals, then you've got work to do. Now, the second one is you come under Darwinex's regulatory compliance. Now, this is a huge one because depending on where you are in the world, but to get the regulatory compliance that you would need to actively manage capital and to take investor capital in, it's going to cost you a significant amount of money. It's going to be a long time and it's going to be a lot of headaches. And even then, you might get rejected for it. So, for example, in the UK, if I wanted to become an asset manager in my own right, I would have to sit certain exams. I would have to pay X amount of money to the FCA as a lockup, just to prove I'm liquid enough to pay out any client funds if needed, and so on and so forth. And even after I did all of that, they could still reject me. Now, going through Darwinex means you basically bypass all of those because you use and piggyback on the Darwinex license. Third, last but not least, you get a proven track record. So this is really important because if you want a career as a trader, it's important for two things. If you want a career as a trader, it's important to attract investor capital through Darwinex. But also, if you wanted to go out and get a job at a hedge fund or an investment bank, your track record is your CV. Now, in an industry that's so full of Ponzi funding firms, you can't really build a track record unless you're trading a significant size personal account and have been for some time. So that's where Darwinex comes into the mix. We're not looking for people who are trying to gamble an account and make $1 million overnight. It's just not who we are. It's not who we're looking for. But if you are wanting to be a professional trader, then that's what we're here for. Now, with all of that said, when you have an account with us, your Darwinex Zero dashboard will not show the same metrics as your MetaTrader. Because we are risk adjusting your trades at Darwin level, they are going to show a different return and a different max drawdown. And the reason being is because we are risk adjusting them. So the Darwin is going to be trading with different size. Now, whenever you're in a trade, your Darwin index will also be in a position. Every trade that you have gets copied over. As long as you're in it, your Darwin will be in it. The key difference is if you trade with a relatively high value at risk and you're trading with a 10 lot, for example, at MetaTrader, and your risk is being cut in half, well, then your Darwin's only going to be taking a 5 lot. Now, what that means is, yes, your return will be less, but also your max drawdown is going to be less on your track record. So don't be surprised if the numbers are different. It's designed to be that way. And trying to get your metrics one-to-one is a really difficult task, and you end up chasing your own tail because it doesn't really matter anyway. Now, what our risk engine does. So we have, I have built a proprietary risk engine, which means it's only owned and used by Darwinex, which monitors your exposure and your value at risk 24/7, 24 hours a day, just like a risk manager would at a professional prop desk or hedge fund or investment bank. You will have a risk manager watching your size, watching your trading behavior, and just understanding the book for the firm, right? So they'll know who's allocated here, who's got this exposure over there. The problem with that is usually it's manual. Usually there's a person watching this. Whereas with Darwinex, because our traders are global, because our traders aren't working in an office for us, we can't deploy a risk manager to every single person. So what we've built is a proprietary risk engine that does it 24 hours a day. Now, what it does is when you enter the trade, the risk engine gets involved, copies the trade to your Darwin, but it risk adjusts it at trade open. And what it does is for every single trader on our platform, it risk adjusts all traders' trade size to maintain a value at risk, or what we call VAR or VAR, of around 6.5% per month across the board. So value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions within a certain level of confidence. Now, I appreciate that sounds like gobbledygook at this point. So we do have an example to kind of break it down and help you understand what this means in a little bit more detail. So if we get the example up, if a trader has a value at risk of $1,000, or let's substitute that for 6.5% in this example, with a 95% confidence level over 1 month, that basically means that there's a 95% chance that that trader won't lose more than $1,000 or 6.5% of the account balance in any single month. Now, of course, we can only do this up to a 95% confidence level because in trading and investing, there's always so many variables that can crop up, and we can't account for all of them all the time. But what we can do is give at least a 95% confidence level to know for investors that the maximum exposure you have on a monthly basis is 6.5%, unless you decided to leverage up as an investor. But that's a different conversation for a different day. Now, by us doing this, what it does is it creates a level playing field, ensuring that every single trader is judged based solely on their skill and just not simply the amount of size that a trader is willing to take or the amount of luck that somebody has. So, for example, if I took the same trades as my friend, but I was a little bit more risk averse, so I traded a 1 lot, but my friend traded a 5 lot, and we entered and exited our trades at the same time, he's obviously going to make more money than I am. Does that mean he's a better trader? Probably not. Does it mean he's willing to take more risk? Absolutely. So what we do is we try and level that playing field between both of these traders, and not just between us, but between the 11,000 that I mentioned that we have earlier on, so that everybody's starting the race from a level playing field. And I've already kind of mentioned this, but you might be thinking, why 6.5% value at risk? And actually, it did used to be higher historically. But 6.5% value at risk is the S&P 500 standard risk level, which we know over an extended period of time, investors are familiar with and are proven to tolerate. And by proven to tolerate, what I mean is happy to leave their capital invested and wait for a return over time. We adjust your strategy to a risk level so that we can ensure that it meets an investor's expectation and risk tolerance. Now, of course, every single investor has a different risk tolerance and they all have different expectations. But as a standard, generally, as you get bigger investors. So we're not just talking to somebody with $1,000, $5,000, $10,000. The bigger investors, their expectations get less and their risk tolerance gets less. So what we don't want to do is expose larger investors to extreme risk, because It's not their goal. It's not their ambition. Maybe you'll find, the occasional one who does want to take more risk. But for the most part, these guys are looking to maintain their wealth. They want 1, 2, 3% per month with a relatively small drawdown. So 6.5%, if we level you out to the same risk level as the S&P and you can outperform the S&P, that's fantastic for an investor because they know their downside is less. They know their downside is managed and monitored. But also they have the potential for higher upside, right? Because on average, the S&P does 10 to 12% per year. If you can beat that with a similar or lower drawdown, happy days. You'll always have a job, okay? You'll always have a job as a trader if you can do that. Now, what you're seeing on the screen right now is the Darwinex Zero dashboard, and the return / drawdown that you can see shows from your Darwin. So this is at Darwin level. If you want to view your signal account statistics on the Darwinex Zero dashboard, you'll see there is a second option that's grayed out for me on this example, where it says signal account with a little lock icon. The reason it's grayed out is because this is protected for your own intellectual property rights. We can't show, especially without your consent or your permission, we can't show what you're actually doing on a trade-by-trade basis. So all of your trading activity is hidden. We show the assets that you trade and the times of day you trade, but nobody will ever be able to see the actual trades that you're in or the actual return that you're generating. We do this mainly because it provides no benefit to an investor. But if an investor looks at your track record and you're having 90% P&L swings every single day, it doesn't look the best, right? So we protect that and we just show your Darwin's return, your Darwin's drawdown, because that is ultimately all that matters. I think I went a bit too far then. So what can you do to understand your value at risk in a little bit more depth? Well, the first thing that you can do is you can take a look at your value at risk chart. Now, this is under the strategy analysis tab on your dashboard. And if you just scroll down to, I think it's the bottom but one metric on that page, you'll see you have a signal account risk management chart, which is basically your value at risk chart. And what this is, it's an organic living, breathing metric. It updates every single day or every single trade that you take, accounting for all of your behavior. And then what it does is it benchmarks that against a previous 45-day trading period, and then benchmarks that trading period against a previous 6-month average. So what we're doing is we're really trying to make sure that you're not being over leveraged or not being under leveraged too. So we're trying to look at your average at all time. Now, what you can see is we've stuck a nice 6.5% line on the chart just to make it easy for you guys who are watching this session now. When the trader is trading above that 6.5% value at risk, the risk engine is going to be tuning their size down. So, for example, at the beginning, it looks like the trader was roughly about 13% VAR. So at that point, the risk engine is going to be cutting their size pretty much in half. So for every one lot the trader takes at MetaTrader level, the Darwin is going to be taking, or the risk engine is going to force the Darwin to take half that size. So 0.5x, or sorry, 0.5 lots. As the chart starts to come down, as your value at risk starts to come down, you have a second metric called your risk multiplier, which is basically the calculation between your lot size on your signal account to the lot size on your Darwin. That will rise. Okay, they kind of work in conjunction with each other, but against each other. So the higher your value at risk, the lower your risk multiplier. The lower your value at risk, the higher your risk multiplier will be. Now, because this is a leave and breathing mechanism, as this comes down, your risk multiplier will slowly and gradually start to increase. Now, as this trader gets to 6.5% value at risk and they begin to cross it, their risk multiplier is probably going to be closer to 0.8, 0.9, or even a 1x. There might be a slight delay or a slight lag, but it's pretty much going to be a 1-to-1 metric because the trader is already operating at a 6.5% bar, meaning that we don't really have to risk adjust anything. Now, it goes even further because when the trader starts dropping below 6.5% bar, our risk engine is actually going to say, well, this trader's not taking enough exposure, so they're never going to outperform the market. They're never going to outperform the S&P. So actually at Darwin level, we're going to tune their risk up. And what it will start to do is it will start to increase your risk at Darwin level. So again, if you're taking a 1 lot on your signal account, but you're operating with a 3.25% value at risk, it's going to be doubling your size, meaning you'll have a risk multiplier of 2x. And for every 1 lot that you take, your Darwin will open a 2-lot position. Now you can see on your Darwinex dashboard, and this is private to you. Again, it is a protected metric. You can see your Darwin live trades. Now, there's a lot to unpack in this image, so we'll go through it bit by bit. This is the risk multiplier that I was telling you about. So this shows you what the risk engine is doing to your position sizing when copying it over to your Darwin. So you can see for this Darwin in this example, what it's doing is it's timesing or multiplying their position sizing by 2.32x. So for every one contract or one lot that the trader is taking on MetaTrader, their Darwin is going to be taking 2.32 lots. The current closure rate, which in this example is 0, this shows if the risk engine has closed any of your trade for any reason. So the risk engine will monitor your open exposure, and we do this by measuring and calculating a metric called deleverage. Now, I don't usually go into deleverage too much because what I've done is I have recorded a load of short form content recently, which is in the Discord, it's on our Instagram, it's on our TikTok, it's on our YouTube, X, any platform that you can think of. And I would recommend going and watching these videos because they're all literally 30 to 60 seconds long. And I explain concepts like deleverage in the most simplistic way possible. So it's better to go and watch that and understand it, because you can keep watching it again and again and again. And it's literally going to take you 2 minutes. Now, the risk engine is going to be monitoring your deleverage, and if at any point your deleverage increases due to volatility or increasing of size, the risk engine can look at it and go, well, we've measured your value at risk to 6.5%. Your deleverage has now increased, meaning your value at risk has now increased. So we're going to close 5% of your position just to bring the value at risk back down. It's rare that this happens, but if you're a sporadic trader and you don't trade consistently, you'll probably notice that this will happen a lot more. Whereas if you take and manage all of your trades in a linear fashion and they do all the exact same things pretty much, you probably find that the risk engine won't ever get involved. And even when it does, it only closes a small portion of the position and only at Darwin level. Now, underneath those two boxes, we then have a list of all of the trades that you're in. So you can see in this example, we have New Zealand yen. It's on a short side, and there's 1.2 contracts or 1.2 lots open on the Signal account, and therefore the Darwin has 2.79 lots open. Now, going back to the example I gave earlier, where there's me and a friend of mine, where we both have different risk tolerances, and we're both approaching the same trades or similar trades, but with a different level of risk. Trader A, in this example, trades with too high of a lot size, and trader B, like I said, was me, trades with too little a lot size. So what the risk engine is going to do, it's going to look between us, try and find the level playing field, which again is 6.5%, and it's going to scale trader A down and trader B up, so that we're both operating from the same level of exposure. Again, 6.5% value at risk at Darwin level. I feel like I say 6.5% value at risk in these sessions an insane amount of times. So to kind of tie up on the topic of value at risk, it depends mainly on 4 factors, right? And this is probably the most commonly asked question I get about risk, exposure, VAR, all of those sort of concepts. Now, what does it depend on? So there's 3 that are kind of small factors, and then 4 that's overarching, or at least that's the way I'll try and explain it. Number 1 is asset volatility. So if you're trading assets at higher in volatility, like Bitcoin or NASDAQ, compared to something like the euro dollar, the assets inherently have a higher ATR or volatility range, or whatever you want to call it, meaning there's more room for that asset to have higher P&L swings on any given day. Therefore, the risk of that trader is slightly higher. Number 2 is your trade frequency. So the more trades that you take as a trader, the more exposure you have to the market, and therefore, again, the higher risk you are. It's not saying that being higher risk is a bad thing at all. So if this is relevant to you as a trader, that's not what we're saying. We're not saying you're getting punished because of trading too much. That's not what we're saying at all. But what we're saying is the more exposure you have, the higher in risk your strategy is. I can see you've put your hand up to speak, Kane. Let me get to the end of the presentation, and I will accept you onto the stage if you want, or just pop your question into the chat, and I'll be happy to answer it as I go. Number three is your trade duration. So again, this is very similar to trade frequency. The longer you're exposed to the market, the more chance there is of something going wrong. The more chances of you round tripping a trade or a winner turning into a loser. More commissions and swaps are going to be paid. All of these different things, which just increases your risk as a trader. Now, the last thing, the one of the factors that overarches all of them, and I say that because the first three are kind of based on your strategy. You have your assets that you trade, you know how often you trade them, and you know how long you trade them for, i.e., you know how long to hold them. Number four is one that's kind of not strategy related, which is your position sizing. Now, this is something that you can change without having to fiddle around with your system or fiddle around with your strategy. You can literally just drop your lots or increase your lots depending on, what your goal is. So it's overarching because you might trade, the least volatile asset in the world. You might trade it once a year. You might trade it for 30 seconds and then get out of the market. So when you look at those three factors, you go, oh, this trader barely takes any risk whatsoever. But then when you enter the trade, if you're taking 10,000 contracts live, it completely obliterates the other three factors because the amount of size that you're putting on that singular trade. Okay, so that's why I say it's a little bit different out of the four, and it's kind of overarching to the other three. Again, you could be trading Bitcoin or a really highly volatile asset. You could be trading 5,000 times a day. You could be holding those trades all for a month. But if you're trading with the smallest amount of lots, again, it's going to reduce your risk right down. So Kane's asked in the Discord, you say that Bitcoin has a high volatility, but signal account contract limits still don't reflect this. Bitcoin is 3x leverage, but NQ is 10x. Yeah, I think you're confusing what I'm saying. I don't mean I just mean as far as an asset goes in general. I'm not necessarily saying relative to your specific account. I'm just saying in general, like value at risk is a concept outside of Darwinex. Okay, so it's not just like something that we've made up. It is kind of a way to measure somebody's risk exposure, a forward-looking metric to measure somebody's risk exposure, as opposed to looking at something like their max drawdown or something like that. So yes, Bitcoin has high volatility. Yes, we reduce the leverage of those, to combat that. I don't know the ins and outs of why we do that because I'm not on the trading operations department and I'm not part of that conversation. But I mean, again, it doesn't really matter because everything that you do is risk adjusted anyway. So you don't really have to do anything crazy with leverage on your Signal account. Now, what you have to remember is we are FCA regulated as a broker, so which is where your Darwin sits and the investors put capital into. So we are restricted in what we can offer leverage-wise anyway. So we have to reflect that to the Signal accounts and to what the traders can access from a leverage perspective. So if we can't offer Bitcoin out of 500x, of course, we can't offer Bitcoin out of 500x. Yes, but it's nearly impossible to lose or make the same amount of dollars with equal contract sizes on Bitcoin versus the NQ. That's correct. That's correct. But again, it doesn't matter too much because everything that you do is getting risk adjusted at Darwin level anyway. So the value at risk of those positions are going to be different regardless. I think you're on any given day, given ADR, so is Bitcoin trader VAR penalized? I wouldn't say you're not penalized. Again, this isn't something to penalize or punish or boost certain traders. It's a calculation to measure or to calculate your risk exposure. That's simply it. So that we know, okay, this trader operates on a day-to-day basis at this risk level. So if we're bringing an investor on and we need to give the investor this risk level, how do we take the trades from this trader and provide it at that risk level to somebody? Now that is either tuning it down or tuning it up or keeping it at the same size, but that's very, very rare. So again, you're not penalized, you're not punished, or you're not boosted. It is just a mathematical calculation. Like we don't have anybody here going, let's punish this trader because they're trading a highly volatile asset. And like I say, the first three on this list are kind of minor in comparison to your position sizing anyway. Bug, I'm going to butcher your name. So I'm not even going to attempt it. So one of the members in the Discord said, if for any reason during the calibration phase you go 18 or 20% negative, so I'm guessing in drawdown you mean, so minus 18 to 20% drawdown, Bogdan. Okay, I was writing it like Bogdanili. So Bogdan, that's perfect. How will this affect you in the future, even if you recover and come back in track? Okay, so first thing I'll say, the calibration phase takes on average a month, right? So it's a 30-day period, roughly. It can take longer. However, like it's pretty much a month. If you're losing 18 to 20% in a month, I would be, and this goes outside of Darwinex, I would be taking a hard look at yourself and your trading and just going, I need to scale this risk back, because that's a big drawdown to go into in such a small space of time. So you can recover from it, and it won't. Your metrics are going to be risk adjusted anyway, so your Darwin is going to be risk adjusted. I know the reason I corrected. Okay, you've got two options. You can either restart the calibration phase and start again, and do it without going into such a significant drawdown, or you can slowly bring your value at risk down. You're going to be risk adjusted, so I would presume that your return is going to be brought down. Your max drawdown is going to be brought down, probably to minus 5% instead. And then like you'll probably feel a little bit punished for a period of time, because your Darwin will be taking such small position sizing. So in future, if you bring your position sizing down at signal account level, it will start to increase and balance out. So I would say if you're in profit at the minute, or at least wait until your Darwin is created. And if you're in profit, depending on how much, it might be worthwhile looking at it and going, okay, well, if I spend the next month, 2 months, 3 months, slowly scaling my VAR down, then my risk multiplier is going to increase and I'm going to come out of it at the back end. Yes, you do. You have the option to restart the calibration phase. You do. But if you want, send me a screenshot of your metrics as they currently stand, and I'll take a look and I'll kind of give you a heads up to what I think you should do. It's hard to say without actually taking a look at it, i.e. how many trades you've taken, the return that you have currently, the max drawdown, all that sort of stuff. Kane said, I'll stop interrupting, hard to type out what I'm saying. Listen, dude, if you want to jump on a call at any point, let me know, or drop me a direct message. I'm always happy to, I'm happy to have a chat. I understand what you're saying. In terms of with 3x leverage on Bitcoin and 10x leverage on NQ, for example, using the same contracts, you wouldn't lose the same. I get what you're saying, but I think we would need to have a proper chat to get to the root cause of the conversation, or an outcome that you're looking for, if that makes sense. Okay, so you went 20% down in 3 days. Okay, yeah, you need to reduce your position sizing big time. I would be, yeah, the first thing that I would be doing for you is dropping your position sizing and maybe restarting, but that's completely down to you. And yeah, I can't tell you exactly what you should do. But 3 days, 20% drawdown is a lot. That just, and that doesn't tell me that you've done anything wrong from a trader perspective or from a strategy perspective. It literally just tells me that your position sizing was too much, regardless of leverage, regardless of account, what have you. It just tells me your position sizing was way too high, especially if you've come out of that drawdown. If there's martingale or grid systems in it, it's not. Let me finish the presentation first, dude, because the people who are watching on other platforms won't be able to hear you. So we can jump on after. So yeah, let me finish up the presentation, which I'm actually doing right now. So all we ask, if you've taken any value from this session, all we ask is you to spread the word about Darwinex Zero. If you're not in the Discord, I would highly recommend coming in there and joining. We have some great traders in there. You're able to talk to me and the rest of the team, get any questions that you want answered, watch all the live sessions, etc., etc. We also have a partner program for traders who have a community or a YouTube channel where you can earn from referring traders to Darwinex Zero, and we can help you grow as an influencer, either being with content or things that we can do together to grow the relationship. And every trader also has access to our member get member program, which basically means that you can earn 3 month subscription by referring your friends, your family, and anybody that you know to Darwinex Zero. At the moment, we also have a 10% discount running with the code DWX10, which is valid for all of our subscriptions, the monthly subscriptions, yearly subscriptions, and 3-year subscriptions. The only important thing to note is with a 3-year subscription, you also get a coupon code for a discount on the permanent allocations as well. So I just want to say thank you everybody for joining this session. It is recorded, so if you missed the start or you want to listen to something back, just go to our X account or our YouTube and you'll be able to replay the whole session along with all of our other sessions that we do. I usually run 3 to 4 per week, and it's probably going to get more moving forward as well. So if you do miss any of our sessions, they're always there to watch back, and we appreciate any support you guys show. So I'm going to end the session here. Bogdan, I will keep the Discord session running if you want to jump on the stage. But for the other guys, peace out. Have a fantastic weekend, and I will catch you next week.